Hi there. Thanks for stopping by the Equity Trust Virtual Classroom. I'm John Bowens, and in this segment, we're going to be talking all about the self-directed solo 401k. I'm going to share with you some of the attractive characteristics of the self-directed solo 401k and why this is becoming an emerging account type for investors that are investing in alternative assets. For real estate investors, for investors investing in gold and silver and private equity and notes, mortgages, trust deeds, and a variety of other alternative assets, it's becoming an account type that is incredibly attractive for a number of reasons. And we're going to talk through that. Now, having all that being said, although I'm incredibly passionate about the solo 401k, it's important to understand that a self-directed solo 401k is not always superior to a self-directed IRA. In fact, you're going to learn in this training from an unbiased perspective that a self-directed solo 401k does not work for every investor. Although I'm incredibly passionate, you might be thinking, well, John, why doesn't every investor that's investing in real estate or notes or gold and silver, why doesn't every investor use a solo 401k? Well, the reason why is because not every investor is even eligible to establish and fund a self-directed solo 401k. For that reason, some investors will be better equipped with a self-directed IRA. So let's jump into some of these attractive characteristics for investors to think about why they should consider one of these self-directed solo 401ks. All right, number one is larger contributions. So with an IRA, let me move away from a solo 401k for just a moment. With an IRA, you're limited to only contributing $6,000 per year when you're under the age of 50. This is for tax year 2020. And then when you're 50 years of age or older, you can contribute up to $7,000. But with a solo 401k, you're going to learn in a few moments here, you could potentially contribute over $50,000 when you're under the age of 50. Once you get to 50 and over, you could potentially contribute over $60,000 to the solo 401k, providing that you have enough earned income. So larger contributions. Number two, the ability to defer your earned income into a Roth component of the solo 401k. And you're going to see these numbers in just a moment. The Roth deferral, what this means is you put money in after tax, it grows tax-free, and then when you take the money out, you pay 0% tax, providing that you've had the account for 5 years and you're over the qualified retirement age of 59 and a half. For some folks, they're told that they don't qualify to contribute to a Roth IRA because they make too much money. These are what are called modified adjusted gross income limits. For all intents and purposes, for folks that make too much money, they're told that they can't contribute directly to a Roth IRA. Now, they could use a backdoor approach where they contribute to a traditional IRA and then convert to a Roth. But either way, again, they're told that they can't directly contribute to a Roth IRA. If you're somebody that's over those income limits, know that the solo 401k with the Roth component does not have that extra step involved. You can simply defer the money that you want directly into that Roth component. All right, that's advantage number two. Number three, the ability to invest in alternative investments. With a self-directed solo 401k, providing that you're establishing the account with the right provider. And I am proud to say on behalf of Equity Trust Company, we offer both a self-directed solo 401k and a self-directed IRA. So we really take an unbiased approach on which account type is going to be a better fit for you. In fact, we encourage you to also speak with your accountant or your CPA to determine which account type is going to be a better fit for you. But what I can tell you is that with a self-directed solo 401k, on behalf of Equity Trust Company here, you have the capability of investing in a wide array of assets beyond traditional stocks, bonds, and mutual funds. So if you set up a self-directed solo 401k with another financial institution, don't be surprised if they'll only allow you to self-direct into stocks, bonds, and mutual funds. With a self-directed IRA and self-directed 401k through Equity Trust, you have the ability to invest in real estate, notes, mortgages, gold and silver, private equity, real estate partnerships, apartment building syndications, oil and gas partnerships. There's a variety of alternative investment options available to you with the self-directed solo 401k. All right, last but not least, number four is the exemption of unrelated business income tax. And this is particularly for real estate investors who want to invest in debt leveraged real estate transactions, whether that's buying houses with a loan or apartment buildings, or maybe investing in a real estate syndication or other commercial real estate partnership. What is unrelated business income tax? Well, we have a whole nother training dedicated to unrelated business income tax as it applies to debt leverage real estate. When your IRA is involved in a debt leveraged real estate acquisition, your IRA is subject to a tax called unrelated business income tax. You would have to pay tax on a percentage of your profits allocable to the debt finance percentage of the deal. So if you bought a property for $100,000 and you borrowed $50,000, you're at 50% leverage. You would have to pay tax on 50% of the net profit. With a solo 401k, under the governing rules of qualified plans, including solo 401ks, as long as the loan to your 401k or the loan in a real estate partnership is structured properly, your solo 401k would be exempt from the unrelated business income tax. It is important to understand that there's UBIT tax as it applies to your retirement plan being run as a business, and there's UBIT tax as it applies to your IRA investing in a debt leverage deal. Your solo 401k is exempt from UBIT as it applies to a debt leverage real estate transaction. If your 401k is involved in a operating business that's flow through, you still have UBIT tax that you would have to negotiate and manage to. So that's a key characteristic specifically for real estate investors, and one of the reasons why some real estate investors find solo 401ks very attractive. All right, so now that you know these very attractive benefits or features, let's talk about, okay, how does this plan actually work? Well, the first step, of course, is open your self-directed solo 401k. Equity Trust, we can provide both the record keeping, plan administration, and custodial services. So we do everything all under one roof for you. You open the solo 401k, and by default, you have the option to contribute into a tax deferred bucket. We call that the traditional bucket, or an after tax bucket, which we call a Roth bucket. So you can put money into either account. You get to make the determination which account you fund. And we're going to show you contribution limits in just a moment. Also know that if you have a 401k, a 403b, so if you have a 401k, you have a 403b, maybe you have a 457 plan, and you leave that employer, or maybe you have an IRA, a traditional IRA elsewhere, you can roll over or transfer the monies into the self-directed solo 401k into this traditional bucket. So let's say you have $200,000 in an old 401k with a previous employer. You can move that $200,000 into the traditional bucket and begin investing accordingly. Now, you will learn you have to meet the eligibility requirements. We'll go through that in just a moment. But providing that you're eligible, you can roll the money over into the traditional bucket. Now, one nuance to remember is that if you have a Roth IRA elsewhere or Roth 401ks elsewhere, unfortunately, you can't take any Roth money and dump it into a newly established solo 401k. Only tax-deferred traditional money can be rolled over or transferred into the self-directed solo 401k. All right, so you got two buckets. What are the contribution limits, you might be asking? When you are under the age of 50, you can contribute a total of $57,000. When you are 50 and over, you can contribute a total of $63,500 to the solo 401k. Now, the price to pay to contribute this full amount is you have to have a substantial amount of active earned income. I'll talk about that in just a moment. This amount, however, is broken up into an employee contribution and an employer deferral. So when you go directly to the IRS website, irs.gov, and you look up solo 401ks or individual 401ks, they refer to them as one participant 401ks, you'll see that it describes these plans as you as a business owner wearing two hats. You're wearing an employee hat and you're wearing an employer hat. So our employee cap goes on, and when we're under the age of 50 as an employee, we can contribute $19,500. When we're 50 and over, there's what's called a catch-up contribution, and we can contribute up to $26,000. Now, this employee contribution, we can defer directly into our Roth bucket. So the money that we put in as an employee contribution can go directly into the Roth bucket. We then have our employer deferral. So you put your employer cap on, and you can defer up to 25% of your W-2 income or 20% of your self-employment income. So depending on the way in which you file, depending on the way in which your business entity is structured, you may have the election of 25% or 20%. So you speak with your accountant or CPA in terms of how much money you can put in the plan. The maximum cannot exceed combined between the employee contribution and employer deferral cannot exceed $57,000 when you're under 50, and when you're 50 and over, up to $63,500. Now, this is for 2020. If you're watching this in the year 2021, this amount went up by about $1,000. So this figure is actually $58,000, and this figure is actually $64,500. So you can contribute a little bit more on an annual basis in 2021 compared to 2020. All right, so those are our contribution limits for a solo 401k. Let's jump right into a client investment example to really get the wheels turning on how this works. So John is our investor, and John is 50 years old, we're going to assume. John has a business called XYZ LLC, and in that business, John has $150,000 in Schedule C income. This is active earned income. There's a reason why I'm saying active earned income, by the way. John has $50,000 in expenses. So John is reporting $100,000 in self-employment income. So John's going to file a Schedule C and a Schedule SE. Now, it doesn't have to be done that way. Some investors have different tax situations, different schedules being followed. But ultimately, I'm just displaying to you a hypothetical scenario that's pretty standard. But again, meet with your CPA or accountant to determine your particular situation. So John has $100,000 in self-employment income. That $100,000 is what we're going to use to contribute to the solo 401k. John is paying on that $100,000 ordinary income taxes and payroll taxes, Medicare and Social Security. Now, you might be saying to yourself, well, wait a second, John, I have income, but I'm not paying self-employment tax on any of that income. Do I still qualify for a solo 401k? The answer is today, if you are not paying any Medicare and Social Security tax, if you are not paying any payroll taxes on your income, then you're going to learn that you don't even qualify for a solo 401k. So you're going to want to visit with your CPA or accountant and determine how you could potentially claim some income so that you could qualify for a solo 401k. So back to our example, we got $100,000. John loves the idea of contributing into the Roth bucket. So John contributes the maximum employee contribution, which is $26,000. So he puts $26,000 into the Roth, and then he defers 20%. So that is 20%, going back to our slide here, 20% of our self-employment income. He defers 20% of 100,000, which is 20,000, that goes into this traditional bucket. Why does the 20,000 go into the traditional bucket instead of into the Roth bucket? The reason why is because the employer deferral is tax deductible. It's just like a 401k when you work for a company. When the company matches you, whatever amount they match you, they get a deduction for it. It's the same process with a solo 401k. So your business is going to recognize a deduction. However, you can initiate what's called an in-plan conversion. In-plan conversion. So what you can do is dump the money in the traditional and then immediately convert it over to the Roth. And your net effect is, in this example, $46,000 in after-tax dollars into the Roth solo 401k. So going back to benefit number one, at the very beginning, I talked about larger contributions. This is larger contributions materializing right in front of you today. Now back to this slide, I can in reality, if I'm contributing or earning enough money, I have the ability to contribute up to 57,000 when I'm under the age of 50, up to 63,500 when I'm 50 and over. And in 2021, that amount's going to go up to 58,000 and 64,500 respectively. So if I'm paying myself enough money, which would go well beyond $100,000, but if you're a high income earner, you could potentially get upwards of $58,000 into a Roth component of the solo 401k when you're under the age of 50. When you're 50 and over, you saw that figure go up to $64,500. So substantial amounts of after-tax contributions. All that being said, if your goal is additional tax deductions for your business, then you can contribute the amounts on the employee and employer side into the traditional bucket here and recognize tax deductions for it. All right, so now that you understand the benefits and you understand the contribution limits, let's talk a little bit about eligibility. I've put together for folks a 4-question questionnaire that I'm going to take you through. And when you reach out to Equity Trust individually, we can assist you in taking you through this questionnaire. And then, of course, team up with your CPA or accountant just to confirm that everything makes sense for your particular circumstances. So here's the first question you got to ask yourself as to whether a solo 401k makes sense or not for you. And by the way, after these 4 questions are asked, if you answer yes to all 4 questions, then a solo 401k is likely going to be a good fit for you. If you say no to even just one, in some instances, you may not be eligible at all. In other instances, it just may not make sense for you. Okay. So question number 1, do you have self-employment business income in which you are paying taxes on? Medicare and Social Security tax, self-employment taxes. So why am I asking this question? I'm asking this question because if you don't have any active earned income, meaning income that you're paying payroll taxes on, Medicare and Social Security and ordinary income taxes, then you're not even going to qualify to open a self-directed solo 401k. You can't just open a self-directed solo 401k and move money in and not show any reported earned income to the business entity that sponsors the plan. You're going to learn in just a moment that that is an ineligible establishment of a solo 401k. There would be a discontinuation of the plan. Question number 2, do you intend on making contributions in excess of $6,000 or $7,000? Why do I say that? The reason why is because the spirit of the solo 401k is that you're taking advantage of the larger contributions. If you're not taking advantage of the larger contributions, then a solo 401k just might not make sense for you. Question number 3, you do not have any employees with the exception of your spouse. With a solo 401k, you cannot have any W-2 employees. Now, 1099 contractors are 1099 contractors, but if you have any active W-2 employees, with the exception of your spouse, you don't qualify for a solo 401k. Now, the spousal exception is interesting. If you have a spouse that's working for your business, even if they're not an owner, you can still have a solo 401k. And if they're working for the business and they have income, they could also participate as a participant of the solo 401k, which means in theory, if you're both drawing a significant income or salary, you can max out your contributions in a very significant way. I know a husband and wife team, they run a consulting business. They both make over $200,000. And so over the last couple of years, they've been able to max out their Roth components of their solo 401ks, generating well over $100,000 in Roth monies in just 2 individual years. All right, question number 4, do you plan on making contributions to this account consistently every year and continue to not have employees? Why do I ask this question? Well, let me go directly to the IRS website. So if you go directly to the IRS website, you're going to find some rules, some guidelines. And on this page, you see no contributions to your profit sharing or 401k plan for a while. Complete discontinuance of contributions and what you need to know. Let me blow this up on the screen for everybody and read this for everybody. While plan sponsors aren't required to make contributions to their profit sharing 401k plan every year, contributions must be recurring and substantial. Contributions must be recurring and substantial. Let me highlight that for everybody. contributions must be recurring and substantial for a plan to be considered ongoing. Employee plans examine guidelines state that if the employer hasn't made contributions in 3 of the past 5 consecutive years, the plan may have incurred a complete discontinuance. So what that means is if you don't have any active earned income at all in your business, and you set up a solo 401k and you roll money over, for example, if you're not showing any active earned income, then you can't meet the facts and circumstances requirement of your contributions being recurring and substantial. Therefore, there has been an ineligible establishment of the solo 401k. Now, that's okay. If you're sitting there today and you're saying, John, I don't have any active earned income in my business, that might mean you just need to team up with your CPA or accountant so that you can structure and devise a plan to be paying yourself income so that you can potentially contribute to the solo 401k. Or if you don't feel that that makes sense for you, then simply invest in alternative assets with your self-directed IRA. Again, solo 401ks have some attractive features, but if you don't qualify for them, you might just be better off with the self-directed IRA. Some real estate investors that only have passive income from like rentals, for example, or private lending, they have challenges with this, but they want to take advantage of a solo 401k. So what some of those individuals do is they create property management companies and they pay themselves a management fee to manage their non-IRA or non-retirement account properties. And then by paying themselves a management fee, they're claiming the income, they're paying the applicable Medicare and Social Security tax, and then ultimately they're establishing a solo 401k and taking advantage of the higher contribution limits and taking advantage of all of the other benefits associated with the solo 401k. So with that being said, I hope you enjoyed this program all on self-directed solo 401ks, investing in real estate and other alternative assets. I encourage everyone to research, explore, educate yourself, reach out to Equity Trust Company if a solo 401k is a good fit for you, and our trained self-directed counselors can walk you through the process, provide the information, and help you establish and fund your self-directed solo 401k or self-directed IRA. Thank you so much, everyone, for joining us in today's program. We look forward to seeing you on the next one.